Welcome to Under the Microscope. I am your host, Jenny Germano. Thank you, everyone, for joining us. We're going to be talking about how cannabis founders are scaling without selling to MSOs or private equity. And before I jump in, I'm just going to give a little bit about my background. I got my start working in the cannabis industry in Colorado in 2009. Running vertically integrated cannabis operations. And in 2015, I founded ICS Consulting, and I've been helping cannabis operators nationally for the last 11 years across the United States. Let's everyone give a warm welcome to our next guest, Darren Gleeman, who is the managing partner of MBO Ventures. Welcome, Darren.
Glad to be here. And
why don't you go ahead and give our listeners a little bit about your background and when you came over to working in the cannabis industry?
My background is hedge funds, actually. Back in 1999, a long time ago, I was working at a financial firm, and we were trading stocks and lots and lots of people, and a bunch of guys, and we found a pattern in the stock market, like a real honest to goodness pattern. And so when you find a pattern in the stock market, you don't go out and tell everybody, hey, I'm going to sell this pattern for $100. What you do is you lock yourself inside a room and you get armed guards and you live in a tent, right? So the pattern, we were able to trade maybe 5 or 6 stocks at a time. But it's a real pattern. So I went to the boss, look, if we can computerize this, we can trade more than 6 stocks. We can trade thousands of stocks. Loved the idea, brought it up to the chain, but the head of compliance is like, no way. If you computerize this, you can literally blow us up. The compliance guy said no, and we went off on our own. Went to another firm. They said they'd back us, same exact problem. We did what you had to do. We went in, we started our own company, put our own money up, took out the debt, did the whole mortgage stuff. We hired a programmer, and we got someone to allow us to use their pipes, another brokerage firm. And after a couple of months, it started in 2001, right after 9/11, and it worked really well. And what we didn't realize is that when you computerize, you can trade thousands of stocks. What's cool is that now we have data. I have data from thousands of stocks and tens of thousands of trades, which means there are more patterns that we didn't even realize. That was the beginning of my quant hedge fund world. And we were trading over 1% of the entire US market every single day, with huge amount of stock, which is insane. And then in 2018, we sold the company, sold the fund to another large firm, actually in Israel, called the 𝗘𝗚. And I can't trade anymore. I can't be a quant. I got into this world since 2018. We've been doing these independent buyouts via this ESOP structure. And in the cannabis space right now, we've structured, or in the process of structuring, over 18 independent buyouts. And in the normal world, we've structured well over 400 of these independent buyouts in the past. Yeah, so it's a lot. So we know what.
That's incredible. That background is so interesting. I always think of The Wolf of Wall Street. I can never get that movie out of my head.
That's a great movie. Now, The Wolf of Wall Street, okay, the difference is The Wolf of Wall Street, what he did is, in that firm, is they would go out and they sell, like they say, hey, Jenny, do you want to buy this stock? Do you want to buy this stock? Do you want to buy this? And then you would buy the stock through them. Those are stock brokers. Because we don't deal at all with people. The computers actually buy and sell for ourselves. We don't.
That's probably better than having to call people on the phone and sell them stock, I would think.
Yeah, people buying stock. Yeah, that's a completely different world, totally from us. We came up with the ideas of why we would buy a stock and then why would we sell it, and then you computerize it. So it's a little bit different, but yeah,
really,
it's funny.
It is one of my favorite movies, though, because it's just,
it's hilarious.
Gosh, how can you not like that movie? It's a great movie. And just the fact that I can't even believe all the drugs that people were doing in the 80s.
Oh my God.
Just the sheer amount of, I feel like the younger generation, they don't even know about Quaaludes and just how crazy it was. I don't even know if people do Quaaludes anymore.
I don't even think you can get Quaaludes. I mean, it's possible.
It's just crazy. I'll go ahead and start. The cannabis industry, it's in a difficult capital environment, as everybody knows.
Yeah.
Operators, they're dealing with compressed margins, limited lending, high tax burdens, under 280, and fewer attractive exit opportunities than many founders probably expected. A lot of the operators are probably asking themselves, how do I grow without taking expensive capital? And I know I get asked that a lot. And how do I take some money off the table without selling my company? And how do I preserve the culture and leadership team that we're built? And so I'm hoping that a lot of what we talk about today will answer those questions that operators might have. Yeah. So I first want to start is, what did you see in the market that made you focus on ownership structure, capital strategy, and these exits? I know you were doing it outside of the cannabis industry.
Yeah. In the actual cannabis industry, it's a very unique industry. And I was speaking with a friend of mine, his name is Grant Schuster, very big in the cannabis industry. And I was explaining to Grant how these independent buyouts work through this ESOP structure. And I explained to him that if you sell 100% of the company inside of this structure, the company itself pays no income tax, no federal income tax and no state income tax. And then we talked about it. He said, in cannabis, they have this thing called 280E. Does this work with 280E? And then he explained to me all about 280E and how that prevents you from taking deductions. Bottom line is, if you are completely income tax free, you pay zero income tax, it does not matter that you can't take deductions. Who cares? You become just like a Native American tribe. Deductions are meaningless. Deductions are just made up from the IRS. So if you take no deductions at all, you're not allowed to take deductions. Okay, doesn't matter. Doesn't matter at all when you're paying no income tax. So I saw this humongous opportunity. It was a humongous. So at that point, I'm like, okay, I'm not going to tell anybody about this. I'm going to put on my private equity hat. And I'm going to go out and going to try to go out and do a roll up in the industry and not tell anybody, because it's such a substantial competitive advantage over everybody. So I went out and we placed what's called an LOI, which is a letter of intent to, like, I don't know, like 100 firms. So we threw out these letter of intents. We had this pretty large company that said they wanted to do it with us. We started to work with them. And within a couple of weeks, while we were doing the due diligence, it just basically fell apart. And that's when we realized, you know what? Maybe we should not be entering the private equity world in cannabis when so many of these firms are like dropping like a rock and we don't know what's inside. They have tremendous debt, super expensive debt. Margins are the same thing. The margins are declining. Let's go and do what we do best, which is investment banking, and go out and tell everybody that this exists, right? So the big problem with that is I knew if I went to regular people, the owners of the companies, they wouldn't believe it. There's no way that anybody would believe that you can run a company and pay no income tax. No one's going to believe it. What I did is I went out to every single accounting firm and every single law firm that I could find in the cannabis industry, and I spent the entire year, it was probably all of 2022, I probably met about 1,000 people. I took meetings with everybody and I explained it all. I went through it. And most people, they're like, that sounds too good to be true. And they just didn't believe it. They didn't believe it. They just didn't believe it. Until finally, it was Denton's. Denton's is the largest law firm in the world.
Yep.
And his name is Eric Berlin. He runs the entire Denton's practice worldwide for cannabis. And I sat down with him and he believed me. But I need to vet this. So took him 3-4 months, spoke to dozens of attorneys. And at the end, he gives me a call. I want you to come in. Here's the good news. And it's all good news. We totally believe you. This completely is the solution. You're right. He then spoke to his partner that he works in the cannabis space, Hannah King. And I got the first client and they gave me an opinion letter on it. And it was off to the races from that one group. And that's how it started. And so now it's really good. So right now we've closed, or in the process of closing, it changes by the day because I have another client about to sign up, but about 17, 18 companies that are in the process of closed or being closed in the space.
That's incredible. I actually love that story, and that cool. All the grinding you had to do for that first year because people just didn't understand. And I think people are cautious in the cannabis industry when things are too good to be true. People are like, oh, this is a lie. This is fake.
Of course. They wouldn't believe me. I wouldn't believe me. You really have to do research to believe it, because I know most law firms didn't believe it either. And in cannabis, it's we have to be skeptical.
Can you explain what the ESOP, the ESOP acronym stands for someone who might not know?
Yeah. An ESOP is an employee stock ownership plan, right? And so there are thousands of ways to structure the ESOP, right? Tons of different structures. The structure that we work with as an independent buyout is we use this structure. It's a trust. So we use this special trust that was created back in the 1970s. And the trust was created because you have, let's say, a hardware store in the 1970s, family run, making a couple of $1 million of profit every year. There's no one to buy it. The kids don't want in. So what do? It's going to fold, and then you're going to fire 50 people. So the government came up with this special thing, the ESOP, right? They came up with a special trust that now this trust can be used to buy the stock from the owner. So the trust buys the stock from the owner, and the trust can also borrow money. And the trust gets a lot of special tax advantages from the government to coerce you to do this, right? And that is what an ESOP is. And it's in those tax benefits. We structure this as a sell the company. When you sell the company to this ESOP structure, number one is the company, if you sell 100% of it, the company runs completely income tax free forever, which is humongous. No income tax forever, right? That's number one. Number two, on the shareholder side, the sellers, when they sell the company to this ESOP, they can defer their capital gains tax on the sale. And if they structure correctly, they can defer their capital gains forever. Now, what that means for the audience is when you sell your company, and let's say the company is $5 million in net income and the value is, I don't know, $30 million. You sell the company for $30 million. Where do you sit, by the way, Jenny? What state are you in?
I'm in Colorado.
Okay, so Colorado. So in Colorado, if you sold your company for $30 million, all in, you're going to pay about $9 million in capital gains tax to Colorado, to Medicare, and to the feds. About $9-10 million. It's a lot of money.
Yeah.
If you sell to the ESOP structure, you can defer that entire $9-10 million, and structure correctly, you can defer it forever. So that's another great benefit. That's a pretty cool benefit. Another benefit is when you sell the company, right away, the company can take a deduction of the entire purchase price of the sale. So let's say, again, $30 million company, and let's say you sell, you know what, Darren, I want to sell a third of my company. Okay, so a third of the company, if it's $30 million, is $10 million. You want to sell it for $10 million. Great. You go out, borrow $10 million, you get $10 million in cash. You're going to be able to defer your capital gains tax. The company can now take a deduction of that $10 million purchase price.
Wow.
Right. That's called pre-tax. You're allowed to take a deduction of the entire purchase price. And then you, as the owner, another thing you get, right? You sell the company. Again, I know I'm going back and forth, but you sell the company, $30 million company. You can get warrants. A warrant is like a stock option, which allows you to buy back into the company. You can get warrants to buy back anywhere from, let's say, 10% of the company to 40% of the company. So you can get warrants to buy back a very large chunk of the company in the future at a very low price. What's called a predetermined price for the next 15 years. It's called the strike price. So what does that mean? Let's say it ends up you want 20% of the company. Sell the company for $30 million. Okay. You get warrants to buy back 20% of the company. To buy back 20% of the company, if it's a $30 million price, to buy back the price to you, the owner, will be about, let's say, $500,000 to get back in, to buy back 20% of your company at any time in the next 15 years. So you sell the company today for $30 million. You defer your capital gains tax. You get those warrants. 5 years from now, you're managing it, you're running it, you're there with the people. Something happens, you grow, it's worth $100 million. Okay, now you want to go public, or now a very large strategic buyer wants to come in and buy you Budweiser for $100 million. Okay, you hand in those warrants, you write the check for $500,000, you get back 20% of the company. The check comes in from whatever Budweiser, okay? You now get $20 million, you're the owner, which you have to pay capital gains on that. But the employees will get $80 million. Wow. That $80 million goes into their retirement accounts, of which they don't pay any tax until they actually take it out. That's why the government does this. It's crazy. That's why the government does it, because at the end of the day, it benefits everybody. It really is, it's government gone right with this whole ESOP structure.
Gosh, that is really incredible.
It's incredible. And when you explain that to people, they don't believe it because it sounds too good to be true.
Well, and what a win for employees.
Oh, yeah. And it costs them nothing. It's a gift from the owners. It's a gift from the IRS. It costs them nothing.
My next question is, why are traditional exits so limited today? And everything you just brought up, it kind of talks about that limitation.
Yeah, in any world, if you go head to head with a private equity shop versus an independent buyout with the ESOP structure, head to head, the independent buyout's going to win every time because of the tax benefits. If a strategic buyer comes in, let's say you have a chain of dispensaries in, let's say it's Colorado, with 15 dispensaries, and again, it's a 7-Eleven wants to get into the space. And let's say the value of your company is $50 million. 7-Eleven can come in and say, I'll pay you $100 million. And I'll give you half stock and half cash. And 7-Eleven stock is good stock, right? And that's good cash. What's going on today, there are no strategic buyers coming in anywhere in the country that's going to say, I'll give you half cash and half good stock. What they're saying is, I'll give you no cash and I'll give you my stock. My stock that's a public company that has dropped from $100 to 10 cents. That's what they're going to give you, which is ridiculous. And no one knows. No one wants that. The entire market, the stock exchange, the stock market, like an ETF, like it's a fund, has dropped something like at this low peak, like 98%. Now it's down like 90%. So these companies, why would you want that stock? So yeah, there is no strategic buyers right now in there, and there's no fresh money coming in. There's money in the space, but not a lot of it. The only money that's available right now is for the independent buyouts, for these ESOP structures. And the reason why there's money for that is because, again, when a lender lends you money, they want you to pay back, right? If I'm making $10 million and I pay $5 million in income tax, I have $5 million in free cash flow to pay down that loan. Now, if it's owned by an ESOP, that $10 million in cash pays zero in income tax. So there's $10 million in tax to pay down that loan. Hence, it's a really good bet for when a lender wants to lend to a company that's owned by an ESOP because they pay no income tax.
It's free money.
It's totally free money. When you don't pay income tax, it's free money. And the reason why is that you can now use that to pay down that debt.
Yeah.
And people like that because you can pay down their debt. It makes sense.
One of the other questions I had too is, what has changed in cannabis capital markets over the last few years? I feel like it's a lot more challenging for people to get access to capital now than even a couple years ago. And they get caught up in capital issues nonstop.
Yeah. When cannabis first came out, it's almost like the internet market that back in the 1990s, right?
.com.
That's right, the .com era where everyone wants to get involved. Like right now, it's AI. Everyone wants to get in AI. No matter what you're doing, you're AI. I'm an AI podcast. I sell flowers, not AI, but everything is AI. So at the beginning with cannabis, money wanted to jump into it. So they wanted to jump in as much as possible. So someone's, I have a little gummy here that I'm going to sell in Connecticut. And someone will give you money. And the terms are still rough, but they give them money. So what happened is over the last couple of years, very few lenders are actually in the market space because a real lender, when I say a real lender, like a bank, like Citibank, JP Morgan, are not in this space. Yeah. And the reason why they're not in this space is at first it was they really couldn't do it. Now they can, there are ways to do it, but it's reputational risk. Until it becomes federally legal, the main larger lenders are not going to be in it. Now my team spoke to 35 of the top lenders in the country, the large banks. And they did this right after the announcement from Trump that we were going to go rescheduling. And of those 35 banks, zero are coming into the space. We've been looking at using the SAFE Act to make it legal, but that's not here yet. So as long as we're illegal or as long as we don't have a Safer Banking Act, the larger lenders aren't coming in. So there's only a couple of lenders. By definition, there's no competition. If I want to go out and I'm going to sell a lollipop and there's 1 million kids around me, I could sell lollipops for $10 a lollipop. I'm the only guy selling it. But if you have 50 people selling lollipops, all of a sudden the price drops. And it's the same thing with lending, same exact thing. So there are not that many lenders. And what happened is over the last 3 years, they've been lending, last 5 years, they've been lending, but a lot of these companies are going out of business. A lot of the cannabis companies are going out of business, which means they can't pay the debt. If you can't pay the debt, what happens? So now the lenders actually take control of the asset, and now they own the asset. And now they have to go and work the asset. So there's large companies like AFC Gamma. I know they made some great loans, but I guess it was difficult. So they went out of the space because it's just too difficult. They don't want to take the risk.
You talked about reputational risk, and this is a really important term for the financial industry in general. And a lot of banks talk about reputational risk in the cannabis industry. At what point are the lenders going to say, okay, we're not worried about the reputational risk?
When it becomes federally legal, then the reputational risk will still be there, but banks will now start to enter it. And okay, I'll give you an example. Ammunition. Okay, guns. All right, any bank is allowed to lend to a gun manufacturer. But let's say you don't like guns. Okay, and a lot of people don't like guns. Do you want to do business if a lender is working with guns? You may not want to do business with them. Hence, that's reputational risk.
Yeah.
So there are certain lenders, a lot of lenders, or most lenders will not deal with guns, and they will not deal with ammunition. Why? Totally legal, but it's the reputational risk. So it's the same thing with cannabis. Once it becomes legal, then that just depends on what the people in the country, where the temperature is going. If it's still 50% against and 50% for, that's still reputational risk. If I'm the CEO of JP Chase, I'm like, it's not worth it. It's not worth it for me. If 70% of the people are in it, 30% don't really like it, you know what? I look at the business, I look at that model and say, look, if this is going to generate for us another $500 million a year, it's probably worth it for us. Let's get a team on it. So that's reputational risk and how that works.
Yeah, I always look at guns in pawn shops as a kind of like a larger risk exposure for banking institutions or financial lending just because of the nature of the business.
Yeah, cigarettes. But with a bank, if they were just looking at it purely in finance, yeah, they could sell ammunition. When you look at a company, you see what they've been doing the last 5 years. If it's been fine, again, they look at the risk and they say, look, I can lend to it. But instead, don't want to be involved, especially if you lent someone and something bad happened with that ammunition. It's not a good look.
Gosh, it's so interesting. One thing I wanted to also talk about is, what are you seeing around founders misunderstanding valuation in today's market? Are people having a hard time with their valuations?
Oh, yeah. I think now it's people realize the valuations that they wanted to get in 2021, 22, 23 are not there anymore. Again, it's the dot-com boom. It's the cannabis boom. There's a couple of people that actually did well because they got cash. But most people, even companies that sold out, a bunch of founders that did super well, 9 figures, they should have been worth anywhere from 50 million to like 150 million. And now they're worth maybe 3 million to 10 million, which is a lot of money, but compared to what they could have gotten. And that's because it's mostly stock. Is when I buy you, I lock you up. So I buy your company for $100 million in my stock, and my stock is trading, and my company's worth $1 billion. Okay? And you're locked up for 6 months. All of a sudden, in 6 months from now, my stock now is not worth $1 billion, it's worth $100 million. And you know what? If you sold your stock on these stupid stock exchanges like the CFC and the Toronto Stock Exchange, which are they're ridiculous stock exchanges, maybe I shouldn't say that, but there's no float, meaning this is from my hedge fund days. Just because you see a price, let's say you see a price of the stock is worth $1. All that means is that if you want to sell one share of your stock, you can sell one share of your stock at $1, maybe 100 shares. That's it. You may not be able to sell 1,000 shares. If you want to sell 1,000 shares, you're going to sell the first 100 shares at $1 and the other 900 maybe at 80 cents. If you want to sell 1,000,000 shares at $1, you're not going to do it. You'll sell 100 shares at $1 and you'll sell 1,000,000 shares at maybe 30 cents.
It gets diluted.
Substantially.
Wow.
Substantially. And people don't realize that. They don't understand that. They're like, oh, I can sell it and buy it. No. They don't understand how the market buys. The market is just purely buyers and sellers. Think about it. Let's say you're bidding for one of these companies. I don't care what it is. You're bidding, meaning you want to buy a stock. And you're the high bidder. I'll pay $1. You're the highest. Everyone else is 95 cents. Are you going to, for $1, you're going to buy $10 million worth of the stock? No, that would be ridiculous. You'll buy 100 shares though, right? And so that's why people don't really understand that. So when people actually went out in this world, I don't think they understood that they're getting stock in companies that are from the CSE, which is basically, they're like lower than like the pink sheets. In a couple of months, you and I could get a company and float it on the CSE. It's meaningless.
We're going to dive into the independent buyout employee ownership structure. Talked a little bit about the buyout. I kind of want to dive in for the employees that are listening. I don't know how much you are paying attention to Rhode Island, which isn't that far from you, but they have these cooperatives that they formed, and they can have these co-op employee founded dispensaries. For an employee, could they do an ESOP with their business?
Yeah, absolutely. Doing a co-op is a huge mistake, because doing a co-op, that just means, hey, Jenny, you and I, let's form a co-op. So now there's two owners, there's Jenny and Darren. And you know what? We have 50 employees. All the employees are going to be part of it too. So now it's Jenny and Darren plus 50 employees, and we all make decisions together. Hoorah.
There's a board, and they all vote.
They can do whatever they want to do. It's just like it's a company, but it's a co-op. We're all together. That's really what it is. We all own the company. That's a co-op. There's no tax benefits at all. It's just you're a company and you're calling yourself a co-op, but there's no real advantage for you as a co-op. Again, the IRS doesn't give you any huge advantages. If you want to do an employee-owned company, it should be done through the Employee Stock Ownership Trust itself. The Employee Stock Ownership Trust, which is what we use for the independent buyout, that's what gives you the special tax advantages, not a co-op. But if you have a co-op, yes, you can then eventually, or you can sell to an ESOP. It makes sense. Yeah, I've been dealing with co-ops for a very long time, and people are like, oh, we're a co-op. This is great. I'm like, I remember the very first co-op. I went up to someone, I think it was called like Honeybee Collectives in California. I think that's what it was. And great guys, super nice. And they're like, oh, we have an ESOP. I'm like, oh, really? Because there were no ESOPs. And they started talking to me, and I'm like, no, it wasn't an ESOP. It was a co-op. And then I explained to them, oh, if you were an ESOP, this is what you would have had. And I pretty much turned them right away. Oh man, we need to become an ESOP, because it's a huge tax advantage being an ESOP versus, like I said, the co-op, which is just a co-op.
I think in Rhode Island, they were just trying to give employees an opportunity to get a piece of the pie in the industry. They created this co-op license for basically employees in the industry.
Yeah.
If they wanted to get the tax benefit, they could turn their co-op into an ESOP.
That's what they'd want to do, is sell it to the ESOP. Exactly.
Yeah, that's pretty smart. When it comes to the independent buyout, does the founder fully exit, or are they staying involved, or how does that work?
Yeah. So normally what happens is when you sell, it's up to the owner. The owner can choose to stay in and manage, or if there is already a C-suite involved, the CEO, CFO, then they can just take off if they want. In the cannabis space, 100% of my deals, the owners are all staying in, the owners are on the board, and the owners are staying in as CEOs.
Who determines what they make? Are they keeping the same salary?
Yeah.
Are they getting a different type of salary?
Yeah, that's a great question. With an ESOP, the only difference between a company owned by an ESOP and any other cannabis, the only difference is the shareholder. When it's owned, if it's 100% sale, there's only one shareholder. Ownership trust is the sole shareholder of a corporation. That's it. So it's the same exact thing. So if you are a regular dispensary chain, you are a corporation, and maybe you have 5 owners, maybe you have 4 owners, whatever it is, maybe there's 1 owner. You're a corporation. When you sell to an ESOP, you're still a corporation. That doesn't change at all. So all corporations, how it's governed, every single corporation in the United States is governed by the board of directors. Mm-hmm. Your company, are you an LLC or are you an S corp?
LLC, single.
Single member LLC. So you don't have a board. You are managed by a member, sole member, Jenny. If you changed to an S corp, you would have a board, and that board sole member would be Jenny.
Yeah.
Right? So with an ESOP-owned company, you have the board, okay? And the board governs the company, just like in any company. So the board determines what the salary is for the CEO or the CFO, whatever it is. So if I was making $150,000 yesterday, and then I become an ESOP today, I'm going to make $150,000 tomorrow. That's not going to change. What will change is, let's say you have a company, okay? And let's say the company's making $5 million in profit, but I, as the CEO, because it's my company, I'm taking $2 million in salary. All right, you can still do that, but if you take that salary and put it back to your true net income, it wouldn't be 5 million. It would be 5 million plus another, let's say 1.8 million, because you're taking a $2 million salary, which is ridiculous. So normally what you would do is, so you would say, all right, the company's not making 5 million. The company's actually making 6.8 million. So the value would be on the 6.8 million, not the 5 million. And after the ESOP goes forward, you'd be taking that same salary of $150,000.
Yeah.
But that's a board decision, just like in any other corporation, it's a board decision.
Well, that's really interesting.
It's a good question.
Yeah, we talked a little bit about receiverships, and they're very popular in the cannabis industry. And people go into receivership for many reasons. Sometimes it can be a dispute between owners. They're not getting access to financial records, and the court has to intervene. I've seen that happen a couple times. But what about for the operators? They feel that they're out of runway, and they think that the next step is receivership. Could this come in and save them from that? No?
No, it's just for the independent buyout, it works for healthy companies.
Okay.
It doesn't work for companies that are on a decline like this, because then who's going to buy it? Because bottom line is there's a value to your company. If you want to use it to sell your company, right? So again, let's use the same example we had before. It's $5 million in net income. If your income is increasing year over year, 5 million, 5.5 million, 6 million, 6.5 million, and you project that you are going to be increasing year over year for the next 10 years, all right, you're selling for $5 million now, your EBITDA is 5 million, net income. You're going to be worth, let's say, a value, let's just make up a value of multiple of 7. So you're worth 5 times 7, you're worth $35 million. You're going like this, you're increasing. That same exact company today is making $5 million, but you have all these dispensaries out there. You have a bunch of competitors who are opening up next door all over, and they're going to be full strength in 18 months. Okay. Now your $5 million in net income, what's that worth? It's going to be declining year over year because of your competitors. So if it goes 5 million, 4 million, 3 million, 2 million, I would say your company is worth a value of maybe, I don't know, $9 million, $10 million, multiple of 2. So that's how you would value that company. That would be the valuation, right? Because think about it. If you were going to go out and buy a company, you want to buy a company that's growing and strong. You don't want to buy a company that is weaker. So that's where the valuation comes. So with an ESOP, it's a special type of thing. With an ESOP, there is a trustee that represents the employees. Okay, a trustee is usually, it's an institution. That's all they do. That's all they do is value trustees, and they're the ones that are representing the employees. They just value the company. So they have to pay something called fair market value. That is a legal standard fair market value they have to pay, and it has never been codified. So they have to pay this legal standard of fair market value. Okay, so that's the max they can pay. If they pay more than fair market value, they can get sued by the Department of Labor down the road. So they have to pay a certain amount. And so what we do is they use a couple of things. They look at the public markets, they look at the private markets, which we've done them all, and they look at something called a DCF method, which is discounted cash flow. So I'm looking at your projections of your cash flow. I evaluate all that together, and we come up with fair market value. That's the price that you're going to pay. So circling back to your question, if you have a company that's in distress and is doing horribly and has a lot of debt on the books, you're not selling it to at all to an ESOP. No one's going to buy it.
People do go around and they buy up these distressed assets. It happens all the time in Colorado. People buy up that struggling companies. MSOs come in here. They just recently bought up. You have operators, for example, in Colorado that might have 20 dispensaries. And what if they're declining, but they have 20 dispensaries? They wouldn't want to put that in the ESOP?
Sure, I would if I can go out after they are in receivership. And now all of the debt has been removed and all the tax debt, someone else is going to be taking over that tax debt or that liability. Now there's value there. Absolutely. And it's get it cheaply. You know, what you would do for that instance is you would set up a new co, right? That new company would go out and acquire all of those assets, which is now debt-free and tax-free. You acquire those assets. This asset, you can tell what their income. You know, every single store. This store is making $100,000. This store is making $300,000. You add it up. And now they're in distress and they're in receivership. So now I can buy it cheaply. Now it's a competitive bid. And those companies, maybe you can buy at a multiple of 3 times their net income and then try to flip it out to an ESOP at fair market value, which could be multiple of 5 or 6.
I wondered if that's happening a lot right now.
It's hard to get the money. So when you buy these distressed assets, you need cash. Everyone wants cash. And there's still not many players with cash. And the larger players don't really want to play in that space. So you have very large private MSOs and very large private SSOs. They know their world. They don't really want to always play in that activity of going to the distressed space. But people do. They do. Yeah, they do. If it's cheap enough and it's get hands to you, yeah, they'll put up cash. Especially you can buy something at 1 or 2 times EBITDA. Oh, sorry, EBITDA. I keep on saying the word EBITDA, and I apologize for the people listening. EBITDA is just a very fancy investment banking word for your net income before your taxes. That's really what EBITDA kind of is. It's just
Thank you. I'm always like, what does that acronym mean? Because I might not know it, and so listeners, right?
Most people don't know. Yeah, it's just a fancy way of saying it's your profit before taxes.
Is there anything else you want to add about 280E regarding cash flow?
Yeah, 280E right now is completely finished because of the rescheduling. 280E doesn't exist anymore for companies that deal in the medical space, right? So if you are an operator, like in Florida, for instance, it's all medical, every company in Florida has been rescheduled to Schedule 3, and that means that 280E does not exist anymore. And for those of you that don't know, 280E is a punishment to cannabis firms that basically says you are not allowed to take any deductions. You can't deduct salaries. You can't deduct rent. When you pay your taxes, you can take no deductions. So you're paying your taxes to the federal government. You're paying taxes based on what's called your gross profit, which is your revenue minus the cost of your goods. So if you're a cannabis store, and basically if you make $10 million and that's your revenue for cannabis, and the cannabis cost you, let's say, $4 million, okay, great. You're going to be taxed on that $6 million. It doesn't matter that you're renting 10 dispensaries for $1 million each. It doesn't matter that you have a payroll of $3 million. You can't deduct that. That's what 280E is. So in the medical space, that has been completely removed. In the recreational space, what they've done is they didn't remove the schedule. So it's still Schedule 1 drug, which means 280E still exists. But we're very hopeful because in the summer, what they did is they sped it up. So I think at the end of June,
there's a hearing.
That's right. It's a hearing. And I think they said it's only going to be a total of 6 weeks. And then they're going to try to go right to the next phase. So we'll see what happens with recreational. Recreational right now, 280E still exists. But when I talk to people for many years, I've already been like, look, this independent buyout, even though it makes 280E irrelevant, it doesn't matter because most likely 280E will be irrelevant.
It's going to be interesting to see what happens on the adult use side. I just saw an announcement from Oklahoma, OMA, which are the regulators. They're an all medical state. And they came out announcing that it's mandatory for every single medical cannabis operator in the state has to register.
So,
which I thought was interesting.
Yeah, that's interesting. So the state is saying they have to go to the DEA and register. I think, I've been speaking to the attorneys about this. People have different opinions. It seems like you have to register. It seems like everyone's going to have to register no matter what. If you're medical, you have to register. So, but stay tuned because I don't think anyone super really knows.
I know. It's so true.
No one really knows. And you have these lawyers, and again, I'm dealing with lawyers all the time. And they're talking in their language, but it's debated. There's definitely debates. Top lawyers are debating.
To be honest, we're all in new territory here. Lawyers can debate all they want. It's still new, and there's so many unknowns for everyone. And I just thought it was interesting that OMA came out and said that every operator, that's going to eliminate some people in the Oklahoma market because they are having some issues in that market with people using licenses as a front for diversion and inversion in the Oklahoma market. And I feel like those people are not going to register, which means they're probably going to take away their license.
Yeah, I think you're right. That definitely makes sense. I didn't even think of what you just said. Yeah, it's a way to eliminate some of the bad actors.
I want to talk about preserving culture, leadership, and independence.
Oh.
I think one fear that cannabis operators might have is losing control. And how does the structure preserve leadership? I know we talked about the board and being a part of the decision process. Is that the only piece, or is there other pieces?
Yeah, no, that's the piece, but it's great because people always ask that. And this is a story from one of the attorneys that we were dealing with. And she was speaking to the owners. They were asking that exact question, and nothing changes. And what happens, I love it. It's like you talk about the ESOP, you structure the ESOP, you're doing it. The ESOP happens May 12th. And then May 13th, the owners come in and they're like, what's changed? Nothing has changed. You're still doing exactly what you're doing. The employees are not running the company. The employees are not managing the company. The employees are still doing what they were doing, and the owners are still doing what they were doing. The only difference is that specific owner now, the actual owner, becomes the trust, but the board, what will happen normally is, let's say you have a company, and let's say there are 4 board members. And let's just, again, $5 million in net income, you sell the company for, let's say, $30 million. That trustee is the one that's negotiating with for the price, and they come to the $30 million price. That trustee say, look, we want you, current board, we want you guys to find another board member. So you'll find a 6th board member that you guys want, an independent board member, and then give me, the trustee, that slate, and then I'll make the decision. But if it's a good independent director, the trustee is going to say yes. They'll go for that. So then you will have 5 board members that make the decisions. And so those board members, they've already built this company. There's no reason to change it to be horrible. So that's why that same group of board will still govern the company, which means those owners, if they're the CEO, CFO, they're still going to be there. For the employees, what changes with them, there is change. And it's a positive change for them is their mindset changes.
Yeah.
Very quickly. Usually it's about, I would say about 12 months to 18 months, because at first they don't believe it. They don't believe it. But yeah, you're going to give me something. What happens is they do believe it once it happens. And then they do work harder, productivity increases. And in terms of the company, retention increases by 300%.
Wow.
When you structure it as the ESOP.
That's incredible. The employees have skin in the game.
They have skin in the game without putting any money up. But yes, because now, as that company, right, if they work hard and everyone works hard, yes, they have skin in the game. And it's crazy because to the point where a couple of years down the road, what they do is they really do take ownership. So if someone is slacking off, they're going to say something, right? Because they're an owner. I don't want you slacking off. Hey, you're supposed to be at 9 o'clock and not 9:30. That affects everyone's price. It really is when you act like an owner, right? Think like an owner because you're an owner. So it definitely changes the mindset.
When an ESOP is present, do the employees get access to any financials or reporting? Are they getting the same information that the board members might be getting?
No, again, it's the same thing. The only difference is the shareholder is the employee stock ownership trust. It's in a regular corporation. It's not a co-op. It's not anything else. It's a normal corporation. So just like in a normal corporation, I could do something called open book management. And I can give access to every single employee my entire books. Open book management, for instance, public companies are all open book management, but no one looks at it. In a public company, you can go and you can see everything, but no one does. So open book management in a private company, I think is awesome. It is awesome. I think it's much more productive for an ESOP to do that, but no one ever wants to do it because it takes about 12 to 18 months. And with open book management, from the level of the janitor to the bud tender to the guys in the manufacturing facility, everyone is going to start learning balance sheets. They're going to learn assets. They're going to learn liabilities. They're going to learn equity. They're going to learn income statements. They're going to learn revenue. They're going to learn cost of goods sold. They're going to learn expenses. They're going to learn cash. They're going to learn all of these things. And it's difficult. But when people do teach these individuals this, it really makes a huge difference. It's just difficult to do. So there's not many companies with open book management. It's not many companies that do it. Yeah.
I want to talk about who this is right for and who it's not right for. What type of cannabis companies are a good candidate? I know we talked about, obviously, somebody on the upward progression is one piece. And then also license types, too. Is it for all license types?
Yeah, all license types. It doesn't matter at all. It's really the biggest things are they're not getting killed and the company is not declining year over year. Or if the company is declining year over year, then it's going to be stopped with your projections. I would say it's really meant for the larger companies. So you're looking at the floor is about 2.5 million in profit. There is no ceiling. And the amount of employees, minimum amount of employees is 20 employees.
Okay.
But it doesn't matter if you are dispensary, it doesn't matter if you're manufacturing, cultivation, the licensing type does not matter at all. Again, if I saw a company and they're at, let's say, $4 million in net income, but they're declining year over year and they're projecting to decline, I would say it probably doesn't make sense for you to do it because we won't be able to raise you debt. Remember what I was saying earlier is that when you were owned by an ESOP, people that lending want to lend to you. But if you're declining year over year, no one wants to lend to you.
Yeah.
Because no one wants to lose money.
So not good for startups, basically.
No, startups should have to give up way too much money. Because remember, let's just say you're a startup and the value, and let's say you're hitting it and you're making $200,000 this year in profit, which is phenomenal, right? For a startup, phenomenal. All right. And you want this, you're getting more employees, and you want to use this structure to be tax-free. I would say to you, no. And here's the reason. For you as that owner, if you are making $200,000 a year now and you're projecting, let's say, in 3-4 years, you're going to make a couple of million, when you sell the company, remember I told you the fair market value? The company is making $200,000. That's how we're valuing it. Not on what we think it's going to be, even though you know it, not what we think it's going to be in 5 years. So $200,000, and let's say use the multiple of 5, I'm going to value your company at $1 million, which is way too low for an entrepreneur that thinks they're going to be making a couple of million in a couple of years. Mm-hmm. So that's why an ESOP is not good at all for a company that is in that position. A company that's in that position wants what's called growth capital. That's where you want more of a venture capital firm to come in and to get you money. Now, venture capital firms were more ubiquitous a couple of years ago, but they're still out there. They still will take the shot. But that's where you want to invest. That's where you want to get the money. What happens with that, you're not selling the company, you're selling a piece of the company and they're injecting money into your firm to grow. So that's what the venture capital firm is doing. They're injecting money in, which is what you need. And then you can grow it much more. With an ESOP, remember, you're selling the company and the value you're going to get is too low because you can't get more than that fair market value piece.
A company could work their way towards an ESOP, but they would have to be hitting those numbers, repeated growth year after year, and then eventually they could do it.
It doesn't have to be, let's say, year over year growth. It's just that you need to not be declining year over year.
Okay.
Again, your revenue this year is 10 million. Next year, your revenue is going to be, let's say, 9.8 million. The year after that, you think it's going to cap out, let's say, 9.5 million in revenue. That's fine. 10 million, 8 million, 6 million, like real declines. It's not going to be good.
Let's say I have the ESOP and stay involved in the business. I do that for a couple years as the owner and then I want out. Is that possible?
In your example, you sold it to the ESOP and you're the owner and you want out.
Sure. Well, you stay in. Let's just say you decide you want to be the CEO and stay in for 5 years.
Yep.
And then all of a sudden you're like, you know what? I'm ready to retire. I want to get out. They just walk away?
Yeah, you just walk away. Remember we were talking earlier about these things called warrants.
Yeah.
So that owner has warrants. And if they have warrants for, let's say, 20% of the company, right? And let's say, again, same example, 5 million in net income with value at $30 million. On 5-6 years, those warrants, if this CEO is doing well and pushing that company, and that company now can be worth $40 million, those warrants have a value of 20%, can be worth $8 million. That CEO does not want to walk away.
Can he sell them back to the company?
Yeah, absolutely. You can sell it back to the company. It's called you're putting it back to the company, and then the company will buy it. You can totally do that. But what you're going to do if you're the CEO and you want to leave, the board is going to go out and hire someone that's going to be better than you. Right? Usually a founder who started a company is not always the best CEO of a growing company.
So true.
Right? It's not. It's just you got to go out there and get someone that has been doing this for a long time. That's who you want to get. It doesn't make a difference if you're the founder. I look at things from 1 to 10, and 10 being phenomenal, crazy growth. Those guys, the CEO, when they come into a company, they may not be the guy or the gal that can go and take a company from the very beginning and push it. Because as Jenny, you're an entrepreneur, it's not easy. It's not easy going from step one to step four at all. It is a grind. It is nonstop. There are ups and there are downs. You get punched in the face, you get up, you get punched in the face again. I mean, it is nonstop. It's grit and determination, and you're always struggling. All right, should I quit? Right? And so
Yes.
that's 1 to 4. But once you get to a certain level, all right, you built it. Now, can you get to the next level by yourself? Most companies, you know what? There are other people that might be able to take you to the next level. And the next level, by the way, for all firms, once you build up your company and is working, if you really want to grow, you have to be buying other firms. You can't grow organically. You have to grow inorganically. That means you need to acquire or merge with other companies. That's the way it is. You're never going to be by yourself and somehow take your firm and just keep going.
You're going to hit a ceiling.
You're going to hit a ceiling. It's usually pretty low when you hit that ceiling. It's very difficult to grow without merging or acquiring.
Wow, that was actually great. Thank you for sharing that. I think that's going to be really helpful. I'm sure people can relate. It is a grind. So
My goodness.
It's hard to believe I've been in the cannabis industry for 17 years. It does require a lot of adversity and grit.
Yeah.
I could go on and on with the list of things it requires. I work with people all the time that want to quit. It's that constant mental challenge as well that you have to face.
Oh, it's mostly mental. It is all mindset. It's just like anything else, right? If you work out, it's mindset. In terms of just life in general is all mindset. I wake up in the morning and I put myself into a position of extreme positivity. And I do that by just being grateful for everything. And when you're starting up a company, you're in that business. God, when you wake up in the morning, you got to put yourself in that mindset. You have to. And then as you get punched in the face, you got to like, all right, I'm learning. I guess I'm learning.
My biggest motto is getting back up on the horse. If anything, 17 years in the cannabis industry has built resilience, and getting the punch in the face is the resilience that you need to build to get back on the horse. And some people can make it, some people can't. It's definitely a challenging. I love being part of the cannabis industry. It's so exciting. Closing up, is there any kind of best practices or things that operators could be thinking about?
Yeah, again, I think every operator, you go into 2 stages. It's you're building. And once you're feeling somewhat comfortable, you're never comfortable. No one's ever comfortable because nobody knows is lurking around the corner. So everybody is always looking at, what if I sold? And I think all owners, they dream, private equity firm can come in and pay me this. Once that's over with, once your mindset is, you know what, there are other opportunities besides the private equity. It's okay. Right now, private equity is not in the space. And by the way, when private equity comes in any industry, by the way, it's not like a Shangri-La private equity. It's not. What they're doing is the same exact thing as an independent buyout, but they're doing it with another organization. The private equity firm's coming in to buy your company. And again, what they're going to do is they're going to give you a little bit of cash. This is in the real world. They're actually going to give you cash. In the real world, they'll actually then go out and borrow off of your firm. So go out and borrow off of your firm, and they give you more cash. Okay, and that's how you get some more cash, which you have to pay capital gains on that. And then what they're going to do is you have an earnout. An earnout means, okay, you said that your firm is going to grow 5% a year for the next 5 years. It's fantastic. As long as it grows 5% for the next 5 years is what you said, then we're going to pay you. If it doesn't grow 5% for the next 5 years, you're not going to get that payout. Plus, you have something called rollover equity. That's private equity. So when you actually delve into it, it's not as great as you would think.
Risky.
It's risky. It's not as great as you think. So it's okay, guys. Private equity, you don't have to do. Strategic buyers will be there maybe, I don't know when, hopefully at some point. But if you're a onesie, twosie, threesie, very difficult for any private equity or strategic buyer to come in.
Yeah.
Because you're just not big enough. So you really do need to scale. So if you're a 2 or 3 dispensaries company, all right, that's okay. If you can merge with another group or a bunch of other groups, it's difficult to do, you can start building your company. And that's how you can start competing. And all of this can be done inside of an independent buyout when you pay no income tax.
That's a lot to think about. Yeah. And the one dispensary operator or grow operator, I just feel like they're just going to struggle.
They're going to struggle, and they struggle in a lot of ways, so they can merge. And what stops them from merging is themselves.
Yeah.
It's just themselves. So
it's true.
What they're going to do is it comes down to 2 pieces, and they have to get over it. They're going to come down to their value versus your value. Okay, I'm worth more than you. And okay, so this is the value. And then it's going to get down to the board seats, right? But again, if you can get over that, try to get over it, because that's how you'll survive. Because again, a 2-store chain is better than a 1-store chain, and a 20-store chain is better than a 10-store chain. That's how you're going to build value. So a 1-store, yeah, I'll buy a 1-store in Colorado. I don't know, 2 times EBITDA, maybe. A 5-store chain, maybe that's now worth 4 times EBITDA. A 20-store chain, it's worth 7 times EBITDA. So get there, and you now have the ability to make a lot more money. So you got to get over yourself. It's very difficult, very hard to do it, but that onesie and twosie, you can do it. And you all know each other too. You can do it.
Yeah, I always hear people say the biggest competition is yourself, because you're always the one getting in the way of your success. And I think that's easy for entrepreneurs to get in their own way. Thanks for addressing the single store operator. And I'm sure there's people listening that are like, I have just one license. How should I be looking at the future? Because I know operators where they're about a year in and they're going, okay, I think I need to open another store, right? I can only get this so far. I need to expand my footprint. So there are people thinking about that right now going, I'm ready to get to dispensary number 2, dispensary number 3.
But imagine this, instead of opening your own store like in Colorado, it's pretty congested. If you merge with someone else, if I merge with just you and I have 1 store and you have 1 store, all right, now my buying power is twice as much, right? And now do we both need to have an accountant? No, we need 1 accountant. And then you merge with another 2-store chain. So now you have 4 stores. Okay, now 4 stores has even bigger buying power, right? And now you can start looking at other things. There, I like that point of sale system much better than that point of sale system. All right. And now we start integrating, having 1 point of sale system for everybody. Now you start to build up your systems and processes, which is what private equity firms do. Now you're a 4-store chain. Now you go to another onesie or twosie and start bringing them on. It's definitely possible. You can do it. Private equity does it. In this world right now, Vireo is doing it. Yeah. They're expanding throughout the entire country.
They just came to Colorado. They just bought up a bunch of people in Colorado.
Yeah. And you know what they're paying them? 0.
And they laid off a bunch of people, but it makes sense because we don't need a compliance officer at every place. Now we have 1 compliance officer,
that's right,
maybe for the whole state of Colorado, and they go and they inspect all the facilities. What do you need? 10 people to do that job. Or they have 1 controller.
You're not going to compete with Vireo because now they're becoming this massive, huge organization. But you can become a mini Vireo, and you can do it. And you know what it is? Here's the mindset. Just do it. You literally just gotta do it. That's it. Do it.
I think this is all helpful. I love everything that you shared. This is exciting. I think this is going to be some really good information for the listeners. Great. Oh, I think this is great. I've never really covered this topic, so this is fun for me too. I'm always trying to find different topics for operators to learn about different things they can do with their business. Thanks again, Darren, for being here. I really appreciate you coming on, and your wealth of knowledge. You're natural at what you do. For those streaming, you can find the podcast on Apple or Spotify and wherever you like to listen, or you can check it out on the YouTube channel, which is at Under the Microscope with Jenny, and you can subscribe to watch the videos. I will have Darren's information in the description boxes. If you want to reach out to Darren to talk to him to get more information, this might be something that's really good for your business that you want to explore. Thanks again for everyone listening and for everyone who keeps tuning in every week across the United States. I know we have a lot of listeners in other countries that tune in as well. Really appreciate everyone. And thanks again, Darren.
Thank you. Appreciate it, Jenny.
Yeah.